It's funny. I've been talking a lot about the bear market. How long will it last? What are good expectations going forward? And I remember, I don't know, it was sometime during the second half of 2022 where people would ask me, is now a good time to invest? Is this risky? And I said, no, where we are now, it doesn't feel risky. It just feels annoying. And so I think to your point, bear market, once you're in it, you're like, okay, this is happening. This is what hopefully somebody has told you was undoubtedly going to happen at some point in your lifetime, multiple times in your lifetime. And now it's happening, and now it's really annoying, but I know that it will end. And that's kind of the one common thread with all crises, which seem uniquely scarier in their own way, is that they all do eventually come to an end. I think it's interesting to think of risk, though. There's so many different definitions. How do you think about defining risk?
So I love that question. And because I think it's something that so many people get wrong, even advisors, maybe most of all advisors, because we talk about, well, you need to take more risk. Well, is it risk? I think we have to properly define risk. And so let's start with how most people define risk, and that is as volatility. This is pretty straightforward. Everything says, well, it's volatile, so it's risky. Well, maybe not. Let's talk more about that. So the way I define risk is one of two things, and that is, first and foremost, the probability of complete and total loss. So meaning whatever you have goes to zero. The first thing I'll say about that definition is it has never happened in the history of the market. We just talked about the fact that the S&P over the last 65 years is up 100x, not including dividends. So the probability of complete and total loss is something that's never happened, and yet it's something that gets talked about a lot. So that's definition number one. Definition number two is any decision that moves you further from rather than closer to your goals. Now, this is one that surprises a lot of people, because if you think of it as any decision that moves you further from rather than closer to your goals, think about this. If you take just and this is something I think we'll maybe get into later, which is the counterintuitive idea of compound interest. But if you earn if equities we know over, say, the last 100 years have earned about a 10% annual rate of return. If instead I would have owned bonds, and that bond return is 5% over the last 100 years. Well, by choosing to own bonds rather than owning equities, albeit equities certainly have sometimes dramatic declines, but let's just say that they still earn their 10%. By choosing to own bonds, I'm actually introducing risk to my portfolio. I'm not saying you are introducing risk literally. I'm just saying that, if by the definition of any decision that moves you further from rather than closer to your goals, obviously any reduction in permanent return is by design or by default introducing risk to the portfolio, because now you have to either work longer or you have to save more. To me, I'm often asked, like, okay, well, what does your portfolio look like? I'm a big fan of the idea of don't tell me what to do with my money. Show me what you do with yours. I'm a big fan of that idea. Well, I own 100% equities, not a single bond in my portfolio. And a lot of people are like, well, that's foolish. To me, it's just being supremely logical. Why would I own anything that's going to reduce my return? Now, I'm not saying I'm shooting for the moon. I'm an index investor. I'm not saying I'm trying to maximize alpha or anything else. I think that's a foolish pursuit, which we can discuss as well. But the idea that I just view it as if I just say, okay, I earned an average return of 10%, and I'm not saying I will, but let's say I missed the mark and it's 8. That's a better margin of safety than saying, okay, I want to own, any amount of assets I introduce to my portfolio that say have an average historical return of 5%. That's almost by very definition going to reduce my long-term return, which means I have to work longer or save more. So it's just kind of unwiring, or rather I should say rewiring, of the way in which we view things. Is it risky and oh, by the way, let's talk about risk again for a second. The idea that an asset class that has gone up 100 times in the last 65 years, to consider that to be risky is just insane. Please explain where the risk is. The risk was not born of the market. It was born of the investor. The only way you lost money is selling at an inopportune time. And so, this speaks to faith in the future and all these other things. The reason that people bail out at inopportune times is because they get scared. And I'm not saying you shouldn't be scared. I'm just saying we should be more rational.
I absolutely love that. And anybody watching us on YouTube can see my head has been down the whole time taking notes, which, again, we talk regularly and I never have a notepad. I'm usually walking or driving or on the move, so I don't have the privilege of doing that. But I really do like this idea that you're talking about, that decisions that move you further from your goals. And people do add bonds to reduce volatility. And if that's going to help you stay the course, that can be very useful. And all else equal, if you have two portfolios with the same average return and one is less volatile, sure, choose the less volatile one. It's going to compound better. But you're right. Investing, because it's all about beating inflation over the long run, you invest to grow your savings at a rate greater than inflation without taking undue risk. And when you're highly diversified, that chance of permanent loss that you mentioned at the front end, very, very small, if not zero. You never want to say anything zero, but basically so.
It has a historic probability of zero. We can't say what the future holds.
And I'd
but
say if the stock market goes to
zero,
we all have a lot bigger problems to worry about. Something is way off with the world, unlike anything that has ever happened. And the other thing is that you mentioned, okay, so we're investing to beat inflation. If you add bonds, that is going to lower your return, which means you have to save more or work longer or spend less. But also when you look at real returns, so returns net of inflation, the volatility of long-term real returns in stocks is far less than the volatility of real returns in bonds. So if eliminating short-term volatility is of interest, again, I think it is important for people to sleep at night. I, like you, am also at 100% stocks. My human capital is the closest thing to a bond that I own. And for those listening, my human capital being my earnings potential, my future income that I'll earn, the future income that my wife will earn. That's really our bonds at this point. But it's really a great point that you make, that over the long term, that can be a much, much riskier decision if we are talking about moving further away from your goals or making it harder to outpace inflation over long periods of time, which kind of makes me wonder, Ashby, how you just think about success in general. So I'm kind of mentioning how I see the first principle reason that somebody should be investing, but how do you think people should be defining success?
Well, I think success is very straightforward. Now, it still runs counter to Wall Street or our industry in general, which is generally speaking, some attempt to beat the market. I've yet to see significant evidence that this is a very strong possibility, outside of a few very serious exceptions to the rule, such as Warren Buffett, Peter Lynch, Bill Miller. It's very rare, but those exceptions don't prove that they prove it's possible, but they don't prove it's likely, which is two very different things. So I think success is extremely straightforward, and that is the chance that the probability that you reach your financial goals or you accomplish whatever your financial objectives are. I can't imagine any other version of success that holds a candle to that idea. I mean, at the end of the day, each of us have some kind of life's purpose. In my case, maybe it's my family first and foremost, providing for them, caring for them, hopefully raising good children, and things like that. That's my success. That's my purpose. But from a financial perspective, being able to provide for them, and both, in the near term and in the long term, obviously, whether it's from an insurance in case I don't make it, or whether it's from, invest, I like the idea of insuring for what can go wrong so you can invest for what can go right. And so success is very straightforward, which is the accomplishment of your financial and life objectives. I don't think it gets any simpler than that.